When I'm discussing our positions, I talk a lot about Elliott Waves, but I don't talk a lot about them in great detail. Um, and so I want to talk a little bit about that today and give you a little bit of kind of a primer on that. Um, Major declines happen in three waves. They're called ABC waves. And this wave C is usually one of the worst parts of it, or the one of the longest parts of it. As you can imagine, as people have bought something and it keeps going down more and more and more, the emotion gets greater, the intensity gets greater, they get more emotional and sell with a frenzy. And so that can make downtrend, the latter part of a downtrend, longer. Wave one is typically a short covering rally where a lot of people are just shorting the stock. Shorting the stock means that you're selling it in hopes that it goes down further, and that's how you make a profit. And so short sellers will come in and short it as it's in the downtrend, and they're so bullish on it as it's in other words, they're more convinced all the more as it goes down lower that it's going to keep doing that. And so when it starts to recoil and find a bottom, they all of a sudden have their position going against them, and they have to cover their position. And when you cover a short, you cover it with a buy. That's what flattens it out or makes it go back to no position, to where you're out of the position you've exited, in other words. And that all that buying pressure coupled with the fresh buyers that are coming in causes a huge push higher, and that tends to be what wave one is comprised of. However, wave two is a correction lower that a lot of people really don't even realize that the new uptrend has begun yet. And so they think that this will go down to new fresh lows. But in wave wave two is the first pullback of the new uptrend. Wave two, in order to be a wave two, can retrace all the way back to the beginning of wave one or the end of wave C, which is right here, but it can't go past it. Wave three tends to be one of the longest and strongest waves out there. Reason being is by this time that it's once wave three gets part of the way underway, major moving averages have been crossed, trend lines have been broken, so a lot of trend traders and momentum traders have hopped on board, and so it produces a ton more buying. Those that were short and holding out have realized, oh my goodness, I'm on the wrong side of the trade, and they have to flip their positions and go long, which is to buy. That causes additional buying. So there's a lot of reasons why this tends to be a long and strong move. Wave fours will either be a sideways consolidation or a three-wave pullback. So in this one, I've just drawn it as a sideways consolidation. And some people mistakenly think, oh, the momentum's died off, so now there's going to be a downtrend. But there's not. It's just where it pictures somebody running. They ran a lot, then they got a little exhausted, so they had to take a little bit of a breather, catch their breath before they could run again. And that's basically what that's like. So wave four would either be a three-wave pullback or a sideways consolidation. Same thing with wave one. It's either going to be a three-wave pullback or a sideways consolidation. I've just drawn one example here and one example here, and I haven't drawn each individual wave within that. Just like within each impulsive wave, which are 1, 3, and 5, those are the advanced waves that really take the trend higher. Within those waves, there's 5 waves within those. So 5 waves there, 3 there, 5 there, 3 there, 5 there, etc. With the exception of when you have a sideways range, it can be up to 5 waves back and forth, 1, 2, 3, 4, 5. Which are called ABCDE waves in Elliott wave language. So wave 5 is when people are the most bullish, the most people are participating, the most people have begun to come into the trend, because when do most people get into the trend? They get into the trend when when they're more confident. And when are they more confident? They're more confident the longer this has gone up. So the longer this has gone up, the more that's their security blanket, the average retail investor out there, that allows them to psychologically be comfortable with putting money to work in the market. And so they tend to get into the market with their first buy orders towards the end of wave 3, somewhere in 4, or early wave 5. Early to mid wave 5 is enormous new money coming into the market for the first time in the particular asset, and it's not long before it peaks because all those who were going to buy have already bought, and it starts to collapse on itself. And so when this pulls back, actually a lot of people, even though it scares them, think that this is a pullback on its way to a new high, and so people will sometimes still load up here because this thing's been running away from them, and they've been wanting to buy more of it because they're greedy, and they're thinking about how their gains could have been so much bigger if they had a bigger position, and then this big correction happens, and they think, oh, now's my chance, and some will load up even more. You get a little bit of a bounce and recoil there, and then the massive wave C happens, which is just usually brutal. Sometimes they can be elongated, sometimes they can be very quick, sometimes they can be very long and drawn out, but wave Cs are known for being very relentless. And so when you're getting into a move, you want to see 3 major waves, and you want to see wave Cs typically have 5 waves within them, so you want to be well into that that wave C, 3rd, 4th, or 5th wave on into wave C before even attempting to buy once again. So sometimes you've seen us buy towards the latter end of wave C, which takes a little bit more patience because after that wave C you get your 1, 2, 3, but it takes a little bit longer to get from here to here, but yet your gains are greater. Sometimes you've seen us get in on a wave 2, getting ready to go into wave 3. The delay time is less. The amount of momentum you pick up and the time you get into the profit is quicker, but the price isn't bought quite as low as it could have, but you have cut down on the time in the investment. So the most advantageous times to get in are close to the bottom of wave C. Obviously, you can do it anywhere in wave 1, but ideally towards the bottom of wave C, towards the bottom of wave 2 are some of your best times to be getting into the stock. At the latest, you would want to be, this is wave 3, you would want to be in wave 3 no later than when it just starts to crest come over the top of the end of wave 1, because you won't have so much more upside potential than you have potential downside loss. And you want to be in this early enough to where even if you're in wave 5 and some of this starts to come over, you're still so profitable because you got in back here, whereas a lot of the retail public got in right here and a ton of the public got in right here. Well, they go negative pretty quick and back into a loss here, and then as soon as they get back about here, most all the people that bought in, the average retail investor, are down on their money, and then wave C just creams them, and so they go big into a loss. So to find out more about Elliott Wave, I would suggest a guy's book. His name is Robert Balin. Robert Balin, B-A-L-A-N. He's got a book called Elliott Wave Principle. You can Google it out there, and sometimes you can find a free PDF out there. And of course, he wrote it in the context of the foreign exchange markets, which is the Forex market or currency market, but that doesn't matter. It applies to any market, whether it's stocks, commodities, Forex, whatever. But I wanted to look at a few things that are in his book. Of course, we talked about the 5 waves here and the 3-wave correction. You can see that's in there, so you can see I'm not making that up. And here's what it looks like more realistically. 1, 2, 3, 4, 5 in a wave 1. ABC corrections, which is 3-wave correction in wave 2. 1, 2, 3, 4, 5 in a wave 3. 3-wave correction for wave 4. 5 waves up for wave 5. Corrective wave, a major corrective wave A tends to have 5. It can have 3 to 5, but tends to have 5 waves within it. Wave B tends to have 3 waves, unless it's a sideways range, which it can have 5, A, B, C, D, E. And then it goes into a wave C, which tends to have 5 waves, 1, 2, 3, 4, 5. So just by looking at that, that helps you to gauge where you are within a trend, because traditional technical analysis alone, by using indicators, RSI, stochastics, MACD, moving averages, etc., won't necessarily help tell you where you are within the trend, but Elliott Waves will. There's also certain rules that define each wave. For instance, these are the no-no formations that can't happen. If wave what you think is wave 2 goes below the start of wave 1, it's not a wave 2. Wave 3 will generally not be your shortest wave, so that would be an improper count there. And wave 4 generally does not overlap the end of wave 1. It can happen briefly in a highly leveraged market like Forex, but other than that, it generally does not happen. And so that would be another no-no. So there's ways to define and rules to each wave within his book that you can see. There's other people out there that write Elliott Wave books, but his is just so much easier to understand. Wanted to look at just a few other pages within his book. Here are those sideways, some of those sideways ranges I talked about. Now these would be the same if this was a rectangle pattern or a triangle pattern, but triangle patterns are very common. When the trend was up, you'll have an A, B, C, D, E move, and then it breaks out generally in the same direction it was headed in originally when it came into the trend. So that's 5 bounces back and forth that I talked to you a lot about in our portfolio and on the charts. If it had been a downtrend, it comes into the downtrend, 1, 2, 3, 4, 5 waves, A, B, C, D, E, and then continues the downtrend. So you've seen me note those quite a bit. You've seen me talk about in some of the charts seeing these falling wedges and how those tend to be bullish and how they tend to go up to at least the top part of the wedge, etc. And those have 5 waves within them, 1, 2, 3, 4, 5. And so so I'll look for about 5 bounces there typically before I get into something as well. There's all kinds of rules and things like that that help you with what they call the impulse waves, waves 1, waves 3, waves 5, etc. that are in his book that I just want to point out that can make it very helpful for you to know how to know when you're in each one of those waves, etc. And then finally, I believe, if I remember this correctly, there is there are even potential trade suggestions on where you would enter certain waves as far as your trades, where you would put stops if you're trading. Again, we don't do stops because we're in investments here, and this is something we're holding over time. And the way that we manage our risk is different. We buy low PEs, buy low price to books, buy some of the biggest companies out there with some of the biggest cash on the books and low to manageable debt, and then we diversify among different sectors. And so that's how we manage risks in investments. But in trades, which you can use Elliott Waves in investments or trades, in investments, you're in things longer, so you look at longer-term charts, daily and weekly charts. In trading, which we're not discussing in the Ultimate Wealth Report, you would be on smaller time frame charts, hourly charts, 4-hour charts, etc. One thing about Elliott Waves is the larger the time frame you're on, generally the easier it is to see the waves. And so if you're on a weekly chart, those waves will usually look very spaced out and distinct. If you're on a 1-minute or 5-minute chart or 1-hour chart, sometimes it can get a little garbled looking and tougher to see. So that's something I would encourage you to if you're wanting to learn more about Elliott Wave analysis. Now, do know that you do not have to know one thing about Elliott Wave analysis to be successful in the Ultimate Wealth Report. It is a form of analysis that I use, that I tell you what's going on, and so I use that analysis, and then I tell you in plain English by showing you on the charts where I think that it's going to go, by showing you in the monthly issues where I think things are going to go. So you never, ever, ever, ever have to know Elliott Wave analysis. You don't have to know technical analysis. You don't have to know fundamental analysis. If you so choose to know any of that stuff, that's what I offer some of this type stuff for. Some will want to dig in and learn and know some of this stuff so that when they go out and pick some of their own stocks in addition to what I pick, they'll know how to better analyze stocks. Many of you have commented that you are a lot better at your charting now because of observing how I talk about the charts and go through them and what stands out to me and what means what to me. And you're starting to pick up on those things and use those in your own analysis when you're doing your own investing outside of what we do in the Ultimate Wealth Report. And that makes my heart feel good because I want you to be able to know this if it is your desire to know this. But keep in mind, we've got people at every desire level. I've literally got some people that don't want to know anything about investing. They just want to invest successfully. So they'll open the monthly issue, go to the recommendation, go place the trade online or call it into their broker, close the issue, and be done with it. And that's a small percentage of people, but nonetheless, that they're out there, and that's okay. I mean, they paid their subscription, they get the stock picks, and they can do that. That's their right to do that. But here's the one problem with that: when those stocks go gyrating and they're temporarily in the negative and they go bobbing up and down and getting volatile, guess what's going to comfort you? Knowing why you're in that stock. That's what's going to comfort you. Knowledge dispels fear. There's a reason why some people can swim with sharks, and I would be scared to death to swim with sharks. The guys that swim with sharks can tell you so much about sharks and how they're acting and reacting, and by just different movements and different things that they do, how they feel about you in their space. And sometimes they know that you can be in their space and then not do something, and sometimes they know that they're getting agitated and you need to move on. And to me, I would just see a shark and be scared no matter what the shark was doing. So knowledge dispels fear. And so if you know how solid a company is, you know something about its balance sheet like we go over in our monthly issues, and you know why I feel that this is a good time to buy it now, that's going to help you a lot when that thing goes gyrating and getting volatile out there and even pulls against us temporarily, because we will not call the bottom on most positions that we get into, nor does most anybody else that's honest out there. So we will seize value, but it's hard to say we've emphatically called bottom, and rarely will we. So anyway, you don't have to know fundamental analysis, but it's beneficial to know why I feel that it's solid. So if nothing else, again, you don't have to be able to pick apart a balance sheet. Just know the numbers when I'm telling you this is a multi-billion-dollar company, makes multi-billion dollars a year in earnings, has multi-billion dollars of cash on its books, has manageable debt levels, has a low price to earnings ratio, which means its price is cheap relative to its earnings. It's got a low price to book ratio, means its stock price is low relative to its net assets that they own, etc. Just know that these metrics matter, and it puts the meat on the bones when it comes to it transforms it from just being a stock and a stock price bobbing up and down to you really thinking about the real company that actually makes products or performs a service and takes in money and makes a profit. So that's the way to properly think about them. Also, again, on technicals, you never have to know one technical indicator or what it means, but that's why I go through the charts a lot, so that you will pick up on a lot of that stuff as I go through them. And if nothing else, though, you'll hear my thoughts about that stock and where I think that stock's going. So even if you don't know what a moving average is or what a RSI is or any of this kind of stuff, doesn't matter. Out of what I tell you, I'll tell you in plain English what I think that that stock is about to do based off of those indicators. So I think that covers everything. I just wanted to give you a little bit of insight into Elliott Wave analysis, give you a place to go learn more about it if you wanted to kind of describe the waves a little bit and some of the emotion and where certain groups of people are coming in at and why they are what they are. They're not just 1, 2, 3, 4, 5s. I mean, they're really waves that are phases of the mass emotional and psychological side of the market that show, like wave 5. Wave 5 is the frenzied time where it's the peak of greed. At the bottom of wave C is the the height of the fear that's out there, and conversely, wave 2 usually is almost just as fearful for investors as the end of wave C, because they fear it's going back to new lows, even though it doesn't end up doing that. The negative sentiment is still the same. So each one of these phases, each one of these waves, is basically charting the psychology of the mass of investors out there collectively, and that's what makes it work, and why these trends do trend the way they do. It's because of how investors react at each of these stages of a trend's formation, and also how they react in each stage of its decline. Okay, thank you so much for watching.